We have now a panel looking at digital financial inclusion, innovation beyond imaginations. It's a fascinating topic of discussion, and I look forward to the perspectives that the panelists will bring to this, particularly in looking at how technology has impacted financial inclusion and providing some concrete examples. We have some innovators on the panel, so with that, I would like to introduce the moderator, my friend and colleague, Juan Crisanto, who is the Deputy Chair of the Financial Stability Institute, which is hosted by the Bank for International Settlements. So with that, Juan Carlos, you have the enviable task of keeping people wide awake directly after lunch.
Thank you very much, Connor, for putting me totally under pressure. Good afternoon, everyone. I'm very pleased to welcome all of you to session 4 of this conference on digital financial inclusion that I'll be moderating. Innovative technologies have the great power to expand access to financial services, and most importantly, to ensure that people actually use those services to improve their lives. However, as we have been discussing during the last day and a half, technology is a double-edged sword. On the one hand, fintech solutions can make products cheaper, can make them faster, can make them more customer-centric. But on the other hand, innovations can sometimes amplify threats to customers and leave behind unconnected and less digitally literate consumers. With this background in mind, we have put together this panel with 3 main objectives. Number 1 is first exploring the main Insurtech developments that are increasing financial inclusion in insurance, highlighting not only the benefits, but also the potential risks connected with these recent developments. Second, discussing the way regulation and supervision have been adjusting to effectively deal with digital financial inclusion in insurance, as well as the remaining challenges for insurance supervisors. And the third objective is reviewing concrete examples of Insurtech products and business models that seek to provide innovative insurance solutions for underserved segments of the population. So to achieve these 3 objectives, I'm very pleased, I'm very grateful to the Secretariat to have convened a very rich panel of insurance supervisors and Insurtech practitioners with complementary areas of expertise. Let me introduce our panelists. To my immediate left, Moises Mochi Cheng, who is the chairman of the Insurance Authority of Hong Kong. Welcome, Moses.
Thank you.
After Moses, we have Hui Lin Chiu, who is advisor at the Access to Insurance Initiative. Welcome as well, Hui Liu. After Hui Liu, we have Seth Eshun, who is head of the Insurance Department of the National Insurance Commission of Ghana. After Seth, we have with us Jordan Glenn, who is Vice President of Clinical Development and NeuroTrack. Last but not least, we have with us Stefan Karpiszek, who is co-founder and CEO of Etherisk. So welcome to all our panelists. Let me just say a few words of the format of this session, since we're going to change a little bit the way we've been running it. So we will begin with 5-minute introductory presentations. Then I'll be posing some questions to the speakers. And finally, we'll be devoting some time for interaction with the audience. For that, I would very much appreciate that you give us your input through questions and through your participation in the polling questions through the IAIS events application. So as Connor said, the overarching principle for me will be, or the overarching responsibility for me would be to keep the time to 75 minutes. We have plenty of issues to cover, so let me apologize in advance because we will not be able to cover all issues related to financial inclusion, but hope to cover the most important. Therefore, let me start with the introductory statements, and let me please ask the floor to, let me start with Hui Lin. Let me start with Hui Lin first. And I would like to ask you, Julien, to please describe the major developments that A2II has observed on digital financial inclusion insurance, in particular the most impactful so far.
Great. Thank you, Juan Carlos.
Sure.
Hello, everyone. I'm Huilin from the Access to Insurance Initiative. And I would like to start by asking the audience to have a quick think about who are the people in your jurisdictions that you feel are excluded from insurance. So roughly, how much do you think they earn? What are their jobs? Where do they live? Do they have a family to support? Do they have access to feature phones, smartphones, to home internet? These are very relevant questions, and how the IAIS has basically put together a profile of what we see as the inclusive insurance consumer is. I'll let you read that for yourself, but basically what's important to point out here is that the inclusive insurance consumer can be one or two or all of these things. And given that we have a very international audience here today, I would be willing to venture that in any of your jurisdictions, whether it's 10% or 70% of your population, there will be people in your population that you feel meet some of these characteristics. Now, 10 years ago, when the A2II was founded, it was quite an early stage in microinsurance and inclusive insurance innovation. So inclusive insurance, how the IAIS see it, is basically insurance that's meant for people who are excluded and underserved, not necessarily only due to low income. And 10 years ago, when the insurance industry started innovating in order to reach consumers that we see as an inclusive insurance consumer, a lot of the innovations were focused on finding alternative distribution channels, because recognizing that the kind of traditional architecture of insurer, broker or agent and consumer didn't really work for inclusive insurance consumers, because basically it was just too expensive. And some of the kind of innovations we've seen in the past were basically distribution through organizations such as microfinance institutions, which you see a lot in the Philippines, in India, through funeral services providers, very predominant in, let's say, South Africa, for example, retailers, utility companies, also very common in Latin America. So these are some of the kind of alternative distribution channels that have kind of helped regulators and industry reach inclusive insurance consumers. And along with these innovations, regulators also found that traditional regulatory architecture didn't really kind of suit these new models as well. So how regulators have responded has been to introduce proportionate inclusive insurance regulations. What this essentially means is coming up with a kind of a definition of a kind of category of microinsurance or inclusive insurance products, and then kind of attaching differentiated kind of regulatory framework to these specific groups of products. So things like maybe slightly simplified training requirements for microinsurance agents, simplified disclosure, shorter claim settlement time. So a lot of them have been focused on the market conduct side of things. So to give you a kind of overview of progress on that front, so in 2009, there were 6 countries that we knew of that had microinsurance regulations. Now, 10 years later, in 2019, you can see that there are 24 countries who have implemented microinsurance or inclusive insurance regulations, and another 24 who currently have these kind of regulations underway. So what has Insurtech and technological developments brought to this landscape? In many ways, what Insurtech has brought is new solutions to old problems. And if we were to kind of classify into kind of different business models, you will see that, I mean, everyone in this room will know that there are just so many different combinations and so many different permutations, and it's probably not very possible to kind of generalize all these innovations into a single new kind of regulatory framework. But so what SendFree has done is to develop an Insurtech tracker, which kind of segregates the Insurtech development or basically categorizes Insurtech initiatives in emerging markets. So to just kind of take you through the list that you see on the slide there. The first one is digital platforms. How they define digital platforms are basically models where kind of human elements in the insurance value chain, all the way from product development to claims, where one stage of this value chain has been changed from human interaction to a bit digital process. So basically very much focused on automation. The second one, that's new data and analytics. So that's basically initiatives where technology has been used to derive better insights into consumer preferences and consumer behavior. So this would include things like telematics, the use of AI and ML, big data analytics. The third one on the screen is tech-enabled partnerships. So this is where the kind of traditional partnership of insurer, broker, agents, and consumer have kind of changed in different ways because of the change in the kind of the underlying technology. So for example, mobile insurance, what you have now is the mobile network operator that is technically the agent, but merely functions as a technological platform. You have the technical service provider, which provides, in a way, sometimes kind of advice on product development, just overall business development as well. Sometimes dealing with the call centers and the selling. And then you also have the insurer in the kind of tripartite agreement as well. So these are tech-enabled partnerships, and where the underlying technology is mobile technology. Fourth on the screen is parametric insurance or index insurance. So rather than, instead of insurance where payouts are based on indemnity, it's where payouts are quantified and then paid based on losses that correlate to an index of some sort. So for example, weather data, yields, yield levels, flood levels, that's also something that's new in the Insurtech scene. Then fifth, we have peer-to-peer insurance, basically digitalized versions of traditional kind of solidarity risk pooling models. And the last one being on-demand insurance, that's also called usage-based insurance, where insurance is kind of basically based on micro-durations and usage for specific events, specific time periods. So in terms of the prevalence of these models, in emerging markets covering Latin America, Asia, as well as Africa, the top two models that Senfree has found are digital platforms and as well as new data analytics. But in terms of whether these are how impactful or which are the most impactful ones on inclusive insurance consumers, thinking about how long these models have been around, thinking about whether these models are genuinely designed to target inclusive insurance consumers, and also thinking about how much scale these models have achieved. The two most impactful on inclusive insurance would likely be in mobile insurance as well as parametric insurance. But overall, based on conversations with regulators and what we observe, lots of research has also been done saying that generally the Insurtech scene currently is not really, in many cases, maybe say for a precious few, it's not really been intended to meet the needs of the low-income inclusive insurance consumers. So I would say that kind of sums up the landscape now.
Thank you very much, Rilene. So basically two key messages. The growth of inclusive insurance regulation, that's very important. The second one is related to this that you consider most impactful, mobile insurance and parametric insurance. But in terms of growth, it has been digital platforms and data analytics. Thank you very much. So now moving from a broad picture of emerging markets, going to Asia Pacific region, okay. And would like to ask Moses, if you could please describe the trends that you have observed in Hong Kong with regards to the insurance market development in terms of Insurtech products that are helping to increase financial inclusion.
Yeah, thank you. Good afternoon, ladies and gentlemen. It's really my great pleasure to share with you the experience of Hong Kong Insurance Authority in promotion of Insurtech as a means of promoting access to insurance and financial inclusiveness. And I can basically summarize what we have committed to do and the strategy that we have adopted in 3 simple words. These 3 simple words is embrace, connect, and encourage. And we found that this strategy really is really helpful in helping the development of Insurtech and helping and encouraging technology providers, service providers to really get into the market and do the job of promoting financial inclusiveness. I think a lot of you understand that while Hong Kong has a mature insurance market, and then our insurance penetration rate is pretty high. But however, I think that when we started to survey the market upon our establishment as an independent regulator of insurance industry in Hong Kong, we discovered that Hong Kong people still need more access to protection in insurance. Now, they buy a lot of insurance. In simple words, they buy a lot of insurance, but on the other hand, when we look at the scope of protection that they're getting out of the policy, we feel that there is a gap that we need to close, and our experience tells us that virtual insurers, with its user-friendly and customer-centric digital platform, can help enhance financial inclusiveness by offering protection products to the underserved segment, and especially amongst the tech-savvy generation. Now, let me illustrate that with some figures. I think the Hong Kong insurance market is mature, as I said, and well-developed. In 2018, we have more than 160 authorized insurers, generating a total annual premium of US $66 billion. And the insurance density is US $8,854, and the insurance penetration is 18.1%. And both rank in both number 2 in the world. Notwithstanding these handsome figures, we have not lost sight on the fact that the lion's share of our long-term insurance products are imbued with saving and investment features. And we need to boost financial inclusiveness by having highly predictive products to be sold to the underserved segment, helping to narrow the protection gap in Hong Kong. So we can actually, we actually introduced 2 initiatives in Hong Kong, the Sandbox for existing license holder, and the fast track program for technology firm which want to be licensed to offer to sell insurance products. And the experience from this process is that virtual insurers entering the market through the fast track could bridge this gap nicely by launching simple products with high protection element and tap into the underserved segments such as the younger generation and the busy but tech-savvy generation. Now, virtual insurers could also serve as an effective channel to promote public education needs and consumer empowerment, helping the public to understand their protection needs in different stages of life and empowering them to choose the insurance product that best fit their protection needs. Now, this is pretty much the long-term life insurance sector. Now, this morning you've heard Winnie Wong addressing you in the panel session on the experience in the non-life sector. I think in general insurance market of Hong Kong, the premium is concentrated in 4 major business lines, namely accident and health, which occupies 30% of the market, and employee compensation, 25%, property damage, 17%, and motor vehicle-related insurance, 11%. Now, virtual insurers could offer a solution by providing innovative and creating demands for new types of insurance products that may arise from increased digitalization. For example, like the e-wallet insurance, which Winnie was describing this morning, and also insurance for cyber risks, which we cover pretty extensively this morning. Now, what we've discovered is that with the competition of virtual insurers, traditional insurers would be pushed to embrace technology, nurturing a fintech ecosystem for the entire market in Hong Kong. Now, but our experience also tells us that to promote Insurtech application, a regulator should be open-minded and has the courage to accept new things, to drive innovation so long as protection of policyholders and potential policyholders is not compromised. Now, this is one very important rule that we have observed very strictly in Hong Kong, is that policyholders' interests cannot be compromised. Same standard apply to both traditional service provider as well as digital service provider. And as an insurance regulator and market facilitator, the Hong Kong Insurance Authority would like to guide and facilitate the industry in harnessing Insurtech correctly to bring greater value to the industry and to the society as a whole in terms of greater inclusiveness, lesser social burden, and a more harmonious society. Now, that's the experience that I would like to share with the audience this afternoon.
Thank you very much. We will come back to the issue.
Sure.
I mean, you mentioned a number of very important topics. One is this embrace, connect, and encourage,
Yes.
which I like. The other one is supervisors being open-minded while not compromising policyholders' protection. But let me now fly from Asia-Pacific region to Africa and ask Seth to please share with us developments in the Insurtech market in Ghana, particularly because you've been put on the spot about mobile insurance already.
Okay. I'll give you the experience about Ghana. Let me take you through the micro-insurance journey as it happens in Ghana. So we started off in 2010. Before then, only about 1.7 million Ghanaians had some form of insurance cover. And this is a population of about 28 million. So you had less than 10% being covered. We currently have a situation in which we have about 30% of the population having some form of insurance or the other. And that is mainly through what we call mobile insurance, which is basically insurance which is sold through the mobile platform. So the innovation that happened there was that the industry and the regulator worked together to allow mobile insurance to be sold through maybe deduction in airtime credit. So what happened was that some clever person came to us and said, okay, we want to start offering free insurance to people. So if you use maybe 20 CDs of data or 20 CDs of credit a month, then what happens is that we will allow you to have free insurance. So people had that for about 6 months. They saw the benefit of that, and then they started charging them for that. And a lot of people who had those free and enjoyed it started buying it. And that was the means by which insurance being sold through took on. We had a few challenges because you then had a number of players in this market. You have the insurance in the companies. Then you have what we call technical service providers who actually do a lot of the designing of the product, the underwriting of the product. The insurance company actually takes the risk. And then there's the mobile network operators or the telcos whose systems or whose customers these things are sold. And so you have a number of players right now in the market. And so there's a need not only for collaboration and agreement between the different players. There's also a need for the regulators of the different sectors to also talk together. So when it comes to the micro-insurance distribution channels, there is the telcos, and they contribute a lot of the premiums. And then there's a traditional insurance companies base. And then in Ghana, there's something we call the susu, so that someone sells in the market. Every day, somebody will go and take maybe 20 CDs and say, okay, I'm writing it down. And that's like a form of banking that is done. And so these same sort of distribution model was used also to then sell insurance. And that is a very trusted way by which people actually bank. And some of the even traditional bankers are also using that. So the insurance companies also adopted this approach in order to get people to buy into insurance. Here is a description of a target group of microinsurance, and it kind of sits very well with what the lady from 82I also said. So it's basically the self-employed people without formal wage. Their salaries are not fixed like how most of us, our salaries are. It's all volatile kind of. And so insurance in which you have to pay premium every year, every month, doesn't really sit well with them. So there was a need for the insurance industry to also think of how they would design products to suit those people. So I would like to focus on some of the key challenges there. The first bit was that this was mobile, sold through the mobile platform. So it was very difficult for policyholders to receive documentation. Most of the documentation they had about the insurance policy that they had was through a text message that they got on their phones. So it is very, very important that in the design of the insurance, there's very little exclusions as possible, so that the products that were sold through there were very, very simple products. So the common products that were sold through there are funeral products, and also what we call hospital cash, which is like an income protection policy that if you stay in a hospital for a certain number of days, each day you stay there, you are given a certain amount of money. So those were very, very simple products that people could easily relate to. Then there were issues with the payment system. We had an issue with the central bank which said that airtime credit is not money. And so they were going to disallow that. And because it was providing such a huge cover, it was one of the biggest challenges that we faced, in which regulatory barriers were not being raised by the insurance regulator, but also a fellow regulator. And there was a lot of time and money spent on trying to get that done. And the last bit is the involvement of the multiple parties in the operations of this. So this really talks a lot more about what the challenges are in relation to mobile insurance. The other bit that we also tried was parametric insurance, which is basically agric insurance. That hasn't gone as well as this has been, and it's mainly because if you take an agric insurance, the premium on it is roughly between 8 and 10% of the sum assured. But if you take home insurance or marine insurance, your premium rate is about less than 1%. So what you find out is that the poorest in the community, who are the farmers, are paying a very high cost of premium. So in most countries, you find out that agric insurance has some level of subsidy, but you don't have that in Ghana. And so there has been a lot of work going on, thinking about ways by which we could find clever means of being able to bring the cost of agric insurance down, not necessarily through subsidizing premium, but through subsidizing some of the inputs that goes into the premium. So it is a parametric insurance which is based on rainfall data. It's based on satellite imagery. So all those kind of things that goes into that could either be subsidized to make the cost that the insurance company incurs in coming up with the product cheaper, rather than necessarily reducing the premiums. I'll quickly go through these risks. I won't spend so much time on them. All that I want to say here is that whenever there is innovation, it brings about new risks, and those new risks need to be looked at carefully. So there are a lot of regulatory means by which you can do that. You can do it through the sandbox that a lot of us are aware of. We can also look at it and thinking about, why don't you pilot this and see the issues that come up? And I think that the key issues, and let me give you a very simple example. The main telcos that we have in Ghana are Vodafone, MTN. Someone has an issue with insurance sold to him by MTN. He goes into an MTN shop to say, oh, I bought this insurance from you, and I have this and this and this problem. But the person selling mobile phones has nothing or no knowledge about the insurance, because even though it is marketed by MTN, they don't know anything about it. So there was a lot of work that we had to do with the telcos and those to let them know that if they want to sell these products, they need to have people that, if people go into those booths or those stores, they can give them advice on it. The other key thing is the policy documentation, and this is something that we are still working on. We had a survey this year, seeing how customers perceive this and how we can really address it. And so let me just end by saying that technology in itself is a good thing. We need to embrace it, but we also need to think about the additional risks it brings so that we can continue to work on our mandate of protecting policyholders.
Thank you very much. You have provided very nice, very simple but tangible examples related to policyholder protection, which I really like. So let me now move to our Insurtech practitioners, and please let me start with Jordan. Jordan, could you please introduce NeuroTrack and let us know how it is helping to reach out to the segments of the populations which are most underserved?
Am I under yours? One more. There we go. Awesome. So NeuroTrack is we're talking a lot today about how we use digital technologies to reach policyholders, reach users, how we make things inclusive, how we avoid some of this financial burden. And what NeuroTrack does, at first thought, and I'll explain the company and then I'll talk a little bit about how we work with and how we're partnering with the insurance world, but at first thought, really, there's not a lot of connection between what NeuroTrack does and natural insurance in kind of its traditional state. NeuroTrack is a digital therapeutic startup that's based in Palo Alto back in California. And really, NeuroTrack was founded to solve two primary problems. And that is the fact that cognitive testing is lacking and that treatment for cognitive decline is poor. And when I say poor, that's actually a very generous term because it's really almost non-existent. And so when I talk about cognitive testing, and this is going to be slightly different between countries, between ecosystems, but overall this process is going to be very, very similar. So we run into two major issues when we think about cognitive decline. One being specialist scarcity, the fact that there's just not enough specialists in the world today to counteract the issue of cognitive decline. Aging is very quickly becoming one of the biggest factors in the entire planet. And we know some countries are further along than others, such as Japan, China. We see it in Singapore. A lot of the Asian countries are seeing this early on. Whereas a lot of for example, in the US, we're maybe 5-10 years away from starting to really feel this. But as a result of increased aging, we have this increase in cognitive decline and increases in Alzheimer's, increases in dementia. And so the inability to serve people who actually need help becomes a very big issue. The other major factor here is that there are inconsistent definitions, tools, or methodologies for actually providing diagnoses. There's some odd 10 different gold standard methods, and if you go to 10 to 15 different cognitive health clinics, see 10 different specialists, you could actually go through 10 different batteries of tasks and get 10 different results. And so depending on the ecosystem you're in, this can take weeks, months, it takes multiple hours with a single physician getting moved on through specialists just to get a diagnosis, which may not even be the same amongst different practitioners. So when we talk about cognitive testing lacking, this is a huge problem when we think about the global scale of how we look at cognition. Once we've actually been able to assess cognition and even get some sort of diagnosis around it, there's no treatment. And what we're looking at here on this slide is you see 3 pink bars, which are essentially drugs that have been approved for the treatment of symptoms associated with Alzheimer's disease, and a ton of gray bars. Every single one of those gray bars represents a failed drug trial for Alzheimer's or dementia. And so there are actually no drugs in the world today that have been, or essentially really approved for the treatment of Alzheimer's. Biogen had a nice announcement a few weeks ago. We may see that in the near future. But as of today, there's very little you can do besides engaging in holistic lifestyle behavior, which we know from the scientific literature is well validated. Things like exercise, diet, sleep, stress, social engagement, cognitive interaction can actually help decrease your long-term risk for cognitive decline and increase cognition. And so that's what NeuroTrack really focuses on, are these two problems. And we do this from really a 3-step solution. In one where we assess digital biomarkers at baseline. We have a cognitive testing platform that uses eye tracking technology to deliver essentially cognitive testing anywhere that somebody has access to a smart device with a camera. Based on the way an individual's visual response occurs to a series of stimuli on a screen, we can predict somebody's risk of developing long-term cognitive decline within 3 to 6 years, and then help deliver an intervention for them to essentially push out that risk. And that's where really step 2 comes in. We understand somebody's risk in step 1. Step 2, this digital health management, we can help understand exactly where an individual is, what healthy behaviors are they lacking, what are they willing to engage in, and develop a personalized program for them that then allows them to go on their own speed, make changes to their personal life that can help decrease their long-term risk of cognitive decline. And then the third piece is this connected feedback cycle where we continue to test them over time, understand what's working, what's not working, where is their cognition moving up, down, otherwise, and really help them continue to fine-tune that program to ultimately, again, push out that long-term risk of developing decline. And so, like I said, at first thought, the NeuroTrack platform doesn't really fit your classic insurance mindset. But really where we are working today and where we have, and I'll give a case example here as an explanation, is what we've done in the Japanese market. And so I use Dai-ichi Life, which is one of our primary partners in Japan and one of the more innovative companies we've been able to work with in the sense that we've worked with them to develop new insurance products, specifically dementia insurance, that is being sold out, combined with a NeuroTrack platform to really help, one, get people insured for conditions in which they very much may be at risk for, give them the tools to push out that risk or really help reduce their risk of developing that long-term disease, and then help ultimately, that helps Dai-ichi, they are able to retain policyholders, able to retain premiums, the end user is able to maximize their health and really provide themselves a long quality of life that they're with their family, and then of course NeuroTrack becomes the glue that helps really bring that together. And so there's a lot of ways in which we think about innovation within the insurance market through those routes, being either a benefit, and there's opportunities at the time of underwriting, throughout the life of the policy, at adjudication, where we really can help people understand, specifically in the cognitive health space, as a kind of third-party provider, where we can really work with insurance companies to provide these benefits to policyholders. And so I'll finish with that. There's a number of examples we can use, and I think that'll come out as we go through the panel. But really, I think what I want to finish with here is the fact that when we're looking at insurance markets, really it comes down to finding the ultimate kind of mix between people who are willing to be innovative and startups that are willing to meet the regulatory barriers that come along with it. Because when you first start, they're very, very far apart, and there's a lot of work that has to be done to bring them together. But there is a very nice marriage between the two that is starting to come up, and one that we can continue to work on together to bring into the future.
Thank you very much, Jordan. Let me now move to Stefan. I wonder if he can also present EtherRisk and again tell us how this is his insurance products and his approach is helping to reach out to the underserved segments of the population.
Yes, thanks so much for having me. So I think I'm one of the tech guys that the previous panel was calling for, that is kind of venturing into the insurance space. I'm one of the co-founders of EtherRisk. It's a very young project. We exist now for 3 years. We started in 2016, and we are building an open and freely accessible platform using a lot of blockchain technology and in particular smart contracts. And our goal is to enable a lot of insurance businesses, a lot of small insurance businesses, a lot of inclusive insurance businesses. And I have brought you a few examples, and I hope to show that this very innovative and also very young and immature blockchain technology can really help customers, and I hope also regulators, with some very tangible benefits like heavily increased transparency, provable fairness, very strong guarantees for customers and for capital providers. And I'd like to show you an example that has been built by a group called Team Raincoat. And what you see in this picture is a hurricane approaching Florida. I think you might be familiar with this. That is Hurricane Michael from 2018. And this was last year one of the product tests for Hurricane Guard, which is an innovative product that protects against damages from hurricane and other catastrophes. And this is parametric insurance. And what you see up here, the blue crosses that you see at the coastline, those are policyholders. And what Team Raincoat achieves using blockchain technology here is instant payouts. This means as soon as the wind speed at this location passes a certain threshold, the policyholder receives a payout. Now, Team Raincoat consists of a few people, 2 of which come from Puerto Rico, and in 2017 they have very personally experienced the drama when a Hurricane Maria, I think, hit Puerto Rico. And this happened in 2017, and some of their family members, 1 year after the hurricane, were still waiting for their insurance payouts. This is a big, big issue, and it's no wonder that people in such countries lose the trust in insurance if the insurance companies just fail to deliver and fail to pay out. And I think in this case in Puerto Rico, it was even that the government had to sue the insurance companies because of their failure to pay out. With parametric insurance and using smart contracts on blockchain, this just cannot happen. You have a strong technical guarantee that as soon as a technical parameter is met, in this case wind speed, the payout happens. And if we can integrate this nicely into one platform using digital currencies, the payout is really instant, and as soon as the wind hits, the customer has the payment in his account. And we think this is great customer experience and really helpful. Another example that I want to show here is crop insurance. Again, parametric insurance that is building on the EtherRisk platform. We are building this together with a large insurance broker and with Oxfam in Sri Lanka, and with the help of local insurance company and local farmer organizations. And the principle is very similar, this time with rainfall. As soon as there is too much rain or too little rain over a crop season, the farmer automatically gets a payout. We have now very successfully concluded our first crop season and are now rolling this out again and learning from the experience and collecting a lot of so far very positive feedback. And we are also very easily, this is open source software, so we can easily copy the model to other markets, and we have a lot of interest from other countries as well. And finally, for the regulators, a very interesting aspect of this blockchain-based insurance, we like to call it decentralized insurance. And I have brought here an example from a different project. So this is not EtherRisk, but these are our friends working in the same space, Nexus Mutual. And what I would like to point out here is the blockchain stores all the transactions, and if it's a public blockchain, this data is freely available and is very transparent and visible to anybody. And this is a monitoring tool that visualizes this data. And as you can see the total funds that are currently in the risk pool, and you can see the total cover amount. Now this is heavily over-collateralized, but this makes it possible to monitor capital requirements in real time. So if you compare this with your traditional approach to, for example, check Solvency II compliance with traditional insurance companies, with these models, you and also every customer and also every competitor in this market can monitor how much premiums come in, how much payouts go out. You have complete control over loss ratios, etc. And from our perspective, this transparency is something that the insurance industry, every insurance company that we are talking to, does not like that level of transparency. From our perspective, it massively helps customers, and it massively helps customers to gain trust into such insurance products. That's it from my side. Thank you.
Thank you, Stefan. And my award for keeping the 5-minute rule. Thank you very much.
You're welcome.
So let me change a little bit the path in the interest of time. Let me ask you a few questions. I will come back to you, Stefan and Jordan, because you have alluded to the interaction with regulators. And this is very important, being this a conference for regulators. I will come back to ask you a very provocative question in terms of, as a small Insurtech firm, what are the main obstacles and challenges you face in terms of getting your license, or in terms of interacting and going ahead with your insurance products when you operate or when you interact with insurance supervisors? So that will be the provocative questions I will ask you. But while you prepare for that questions, let me ask one question to Hugh Lin. And this is a question in terms of, you have a very interesting experience with the Inclusive Insurance Innovation Lab. IAIS have done a wonderful job there in terms of trying to respond to this difficult question, how to expand the use of inclusive insurance, especially for vulnerable populations. If you could sort of complement, because so far we have identified a major risk, which is this risk of consumer protection. In that experience, is there any other risks or benefits that you have come up from that experience, Hugh Lin?
So just to give everyone a bit of context as to why the IAIS is running Inclusive Insurance Innovation Labs, we are the financial inclusion implementation partner of the IAIS, and we support capacity building initiatives for insurance supervisors. So one of the initiatives that we rolled out, we piloted recently, and we are doing kind of the second round this year, is the Inclusive Insurance Innovation Lab. And what that is a series of workshops, both national and international, comprising 4 country teams. So how it works is that each country team, so for example, in the pilot round, it was Ghana, Kenya, Albania, and Mongolia. So each country team, insurance supervisor will lead a team of about 8 stakeholders from insurance industry, brokers associations, sometimes consumer groups, sometimes policymakers if necessary, to basically sit together in a facilitated workshop to solve a problem statement related to access to insurance or insurance market development together. And the idea of this kind of workshop is that, in a way, you kind of put aside your regulatory hat and your industry hat, and you kind of engage as peers and work together to identify common goals and common problems and what you can do to kind of overcome barriers from everyone's side. So where I'm driving with this is that definitely one key lesson we've learned from this is that constructive dialogue can lead to really good outcomes. One example we had was, so this will all be out in a report that is either has been published or will be published in the next few days. It's going to be available on our website, where it goes into a lot of details about outcomes. But one key outcome was with, let's say, Mongolia, where sitting together in the workshop enabled everyone to identify that a key regulatory barrier to rolling out digital life insurance models was the regulatory requirements surrounding e-signatures and basically sending, basically the mailing of hard copy insurance contracts. And having identified this in the workshop, then the regulator was able to kind of pursue this with the appropriate policy makers and make the regulatory changes. And within a few months after that, insurers were able to start piloting digital life insurance policies. So I think the point here is that from what we've seen, from the point of view of insurtechs and insurers, what they really want is to navigate regulations and get regulatory clarity. Just tell us whether this is compliant, not compliant. Tell us what you want us to do. And I think and also, of course, approval times as fast as possible will be good. And from the regulator's point of view, what they want is to be able to understand business models, to enough critical detail to kind of answer the questions that they have. That basically it's derived from the regulatory principles that they're trying to adhere to. So, for example, like consumer protection. And another example is with Ghana. So when we did a recent case study on the mobile insurance landscape with Ghana, and then we interviewed a couple of industry players. So some of the kind of responses that they gave in the interview was things like, oh, we are very clear that the NIC Ghana's priority is on consumer protection, and that this is their priority. And so we were able to have that conversation with them about how should we change our disclosure practices in order to kind of meet the principles that they want to achieve. And basically from this kind of two-way dialogue, then the industry layer was able to innovate their business model in a way that that was apparently still cost efficient for them while still kind of meeting the regulatory expectations. Yeah.
Thank you very much. So, Jordan, Stefan, what are the major regulatory challenges that you have encountered in your dealings with insurance authorities? And then I will give the floor to comment on what you say to Moses and to Seth, okay? Please, go ahead. And then Stefan.
Yeah, thank you. And I'll be super interested to hear what Stefan has to say about this as well. There's really three categories that I think of when I think about our experience having gone through the regulatory issue or the processes that we have struggled with. And I think when I speak from this, I'm speaking from scars that the company has gone through and then kind of learning how to work in this environment. I think the first one I would hit with is time. Time is, so if we think about as a startup, we live in this world of build, break, learn. And that model works on sometimes a weekly to bi-weekly basis where we are building, we're breaking, we're learning, we're iterating on the fly. But regulatory industries don't work that fast. And so we ran into a number of issues where we were building, we were iterating, we were changing, we were adapting, things were happening. And really it kind of leans into this issue of continuity where anyone who's built product from scratch or has worked in a company like that, you start out to build this and you end up with these. And where the product ends from where you start is usually very, very different than what you initially envision it to be after you've gone through user testing, you've gone through the market research, you've got it in front of users, how all that works. And so when we were working with regulatory bodies, what we originally thought that we needed to work with actually became very different at the end of the day. And so we had to go through multiple iterations and back and forths and levels of complexity when just trying to think about what were we going to deliver, how was it going to be delivered, what was the model that it was going to be accessible in for the user. And so all of that had to be taken into account. And so now when we think about how we would approach that, we think about it very differently where we would want to do all the testing internally before even starting those conversations on the regulatory side, just because of how different things become. And so that to me, that's really one of the big issues that we ran into as we were going through this. And I think the other big one, I think, is we didn't understand. So we're not, like I said, I am not from insurance. Our company in general is not from insurance. We have found a nice market in insurance. But we didn't realize the complexity when we think about regulatory bodies. And so even working within just Japan, you have multiple entities, multiple levels of regulation. There's not just you have to hit this checkbox and this entity and you're done. There are multiple avenues you have to hit, and some of them can be done in tandem, some of them are completely different, and those were other areas that we didn't anticipate. So we would build for this one entity, build to hit XYZ set of regulations, not accounting for the fact that there was 2, 3, 4 other areas that we needed to be working for as well. We'd need to pull back, rebuild, recode, redevelop, redesign to essentially be able to hit all of the factors we needed to do to be able to partner with our partners and actually launch this out to the consumer. And so those were really some of the lessons that we have learned as a small company, as a startup working within this space, is just kind of how to really take a step back and approach the problem as opposed to our natural environment, which is just move quickly, learn, break, which doesn't necessarily work when we think about how you approach this high-level regulatory body.
Excellent. So I think I can tell a lot of stories, but I try to keep myself short here. So we have also encountered a lot of challenges, and let me be clear, I like very much talking to regulators, and I think it's part of our mission to educate regulators on new technology and what the opportunities and also the benefits with new technology are. And we've encountered a lot of challenges. And I would like to ask the audience now, please raise your hands. Who of you here in this room has used blockchain before? You see, that's our challenge. It's like 5 or 6 hands went up. Yeah? I estimate maybe 100 people in the room. Yeah? The 94% are our biggest challenge. Because I always claim, and I've done now 5 years of blockchain education for executives, for managers, you don't understand this technology if you have never used it. And I invite you all, I'm still here until 6 o'clock. If you come and meet me afterwards, I will send you a few tokens, a few cryptocurrency tokens, so that you can experience this technology yourself. Yeah? So if you're interested to learn about this, please come and find me afterwards. So this is the first one. Then maybe another question to the audience. For who of you does the word blockchain have a negative connotation? No, not so much. Okay, then we don't have a problem here. That's cool. So that's already good. Yeah. Then I think we touched on this before. The relation between insurance products and non-insurance products is an interesting one. I still remember when we first, when we joined our first regulatory sandbox. that was big fun, because the regulator basically asked us, and I'm not sure if he's in the room. I've not seen him yet, but the person we were talking to asked us, well, so you want to do insurance on blockchain. Are you an intermediary or are you a risk carrier? And I said, well, we are both. And this just did not fit. Yeah, so we had to decide. We need to be either one. Yeah? We can't be both at the same time. That's impossible. And that was a big challenge. And maybe another story. We recently asked a European regulatory authority to come up with an opinion or with a recommendation whether or not a specific model that we proposed was insurance. In our opinion, it was not insurance because it was really not meeting the legal definition of insurance. So, to make it very short, we were replacing the legal promise to pay out the legal claim with a technical guarantee. Yeah? There is a piece of software that guarantees that this payout will happen. And so we were asking the regulator, do you think this is insurance? And if it's not insurance, are we free to operate something like this, such a technical arrangement, and offer this to customers? And the answer was, yes, in principle you can do this. We agree, we don't think this is insurance, but you have to tell your customers that this is not insurance, and you have to do so in writing. And emails don't count. So, in fact, what we had was a highly automated process with instant payouts and instant underwriting. Literally, the customer, it takes a minute to get this policy, and it takes another minute to process the whole claim. But we need to send the customer a letter and tell him that this is not insurance. No, I'm glad that you are laughing, because that was, and now, so, I mean, they are very helpful and extremely friendly, and we are in dialogue, and we are looking at ways to overcome this, but these are the challenges. And I appreciate, and I think the fact that you are listening to me already shows that we have an open-minded audience here. And lastly, I would like to point out one thing that is my personal observation. I think that a lot of the regulatory scheme is really designed for this profit maximization approach within insurance companies, and to kind of balance this tendency of insurance companies to maximize their profits. And now if a new project, if a young project comes and proposes something which not really has a business model behind it and works more like an open source, free and open source software project, this does not fit the regulatory model. And that's a big challenge for us.
Thank you very much. Let me ask now to Moses and Seth to sort of comment based on your own regulatory and supervisory experience about the comments made by Jordan and by Stefan. Moses, please.
Yeah, my first response is that as a career lawyer myself, I always insist that the regulation must be transparent and clear to provide certainty to the market. Now that's very, very important. Legal regulations are difficult to understand. So we encourage our colleagues to come up with guidelines and reference material or question and answer to sort of popular issues facing the industry in plain, everyday English, and Chinese, and so that they can understand, okay? And secondly, I think, but on the other hand, I think these regulations need to, we need to balance these regulations with that it's not so stiff that it will stifle innovation. Now, it's very clear. I'm glad the technology service provider realized that the regulators people working in the regulatory authority are not expert on technology, and so we are learning together. And so that's the first word that I mentioned earlier on, is as regulator, we need to embrace technology. And so I encourage my staff, I mean, some of them are sitting in the audience, I encourage them to go and understand, talk to the industry, work with the industry, support them in overcoming the difficulties that they face whilst processing their licensing application. So that's what I call embracing and connecting everybody together, as well as to encourage. And we try to be a facilitator supporting the application of technology in the delivery of insurance services, because we appreciate that technology would help us to reach out to the so far underserved sector of the population. And then in terms of connecting, we actually in our fast track program, which is a dedicated queue for newcomer to go on a special queue, that they do not have to do the normal queuing up. And that's the time element, which again my friend has just mentioned. We want them to go on a special queue so that they would be their application would be considered different from the normal queue that we are accepting application from traditional insurers. Now, another very important element in our fast track program is that if they want to go into long-term business, and if they are just technology service provider, they might not necessarily have the experience and the in-depth understanding of long-term business. So, as part of the program, we require technology firm to team up with someone who is already in the market underwriting long-term businesses. Now, with that, I think the two of them working together, so we connect them, we will let them work together, and so much so that their respective experience and understanding of technology would complement and supplement each other. And then finally, I think we also said that the time needed to, we suggested that instead of letters going up and email going to and fro between the regulators and the applicant, we suggested that they would come and talk to our team of regulators, so that we understand that problem and they understand our problem. A lot of times, processing of application got blocked up because of the two parties don't really understand what the others are trying to get at. So I think by talking to each other and by supporting them and meeting them frequently, we would be able to understand each other better and help each other better. So I think that's the sort of attitude that I describe as an open-minded regulator in supporting innovation in providing insurance services. Now, I don't know if there are ways that I always emphasize to the industry, if there are ways that the Hong Kong Insurance Authority can assist you in delivery of the services, thus benefiting the community, talk to us, let us know. We're ready to listen and we're ready to respond. So that's my reaction to all the issues. And hopefully, I think more regulators are now getting the benefit of attending occasion like this to understand what are the problems facing the market and therefore responding positively to them.
Thank you very much, Moses. What about you, Seth? What has been the approach you've taken in Ghana?
I think it's a two-way issue. In most countries, insurance doesn't have a very good name. So the work of the regulator, one way or the other, is to ensure that there's an orderly market such that the already not so good name doesn't become worse. So that is where most of the time the regulator comes from. Secondly, most regulatory bodies don't have a lot of resource. So there isn't time for them to do testing. So normally, the people who come to discuss with us, it's important that they know that this is where the regulator is coming from. And there's a need for them also to make sure that, one, they limit the amount of testing that they want to do with the trial and errors that they want to do with the regulator. They need to come up with a more firmed up product, and it makes it easier for the regulator to work with them. There are examples that you work very far with someone, and then at the 11th hour, they change the whole approach, and then these are not people who pay levies to you, so you've just spent a lot of time doing pro bono work, and the regulator doesn't really have that luxury. So when the two people know where they come from, and the regulator is also prepared to learn and collaborate, then I think it works for all of us. So I think the innovators need to understand where the insurance industry is, the fact that it's a highly regulated market, and the regulator also needs to do a bit of work in at least understanding what the issues are, and that to me is the biggest problem.
Thank you very much. I think we have time for one or two questions from the audience. There is a question there.
I work for National Insurance Commission, Nigeria. Deploying technology to drive financial inclusion is great. I'm just concerned about the various parties that are involved from end to end, looking at the cost and comparing the management expenses to the risk premium. I don't know how either the operators or any of the regulators here are managing to balance the relationship between the management expenses and the risk premium, especially considering that for most of the products under financial inclusion relates to small premium concerns. So how do you manage this so that the insurer who is bearing the risk can still break even? This is of concern.
So here we have Stefan has volunteered to respond to that question.
So I'm happy to. So first of all, I agree very much. This is a challenge. I can tell from our experience with the crop insurance product, we have very small premiums. It's about $3 to $5 per crop season, the premium, and the payout is between $30 and $50 of value. But for a paddy rice farmer in Sri Lanka, this is existential. Yeah? So our biggest challenge here is the incentives for distribution. So the local insurance company, they operate the product, they understand the product, it's not a good business for them. Yeah? It's commercially not very attractive to go out on the countryside and talk to the farmers or the farmer organizations and sell this product where there is only a very small margin because the premiums are so low. They much rather sell life insurance policies and get much more out of the premium. So this is a challenge, yeah, to distribute those products. And my answer to that question is make the value chain much, much shorter. Make the way between risk capital and the insured person who pays the premium much, much shorter. Exclude all the intermediaries in between and let them interact directly using a technology-enabled platform. That's one answer. The second answer, and that's something that we are also exploring, is move the premium payment up in the value chain. So for my prime example is that Starbucks pays the premiums for their coffee farmers. Yeah. This is kind of attractive for a lot of different reasons. For organizations, for large consumer organizations, this adds to their corporate social responsibility, and it takes the burden from the farmer away to care about insurance as a concept, right? And to care about paying the insurance premiums. So we are exploring this. If you know someone who wants to work on this, I'm more than happy to get in contact.
Okay. Let me add something quick to that.
Yep.
Yes. Microinsurance in Ghana, for example, the premium is about $1, and the sum assured for life is about $200. So what you see is that the biggest challenge for that product is being able to keep expenses as low as possible for it to be profitable to the insurance company. That is why technology becomes such a key thing, because technology allows you to be able to do the distribution, to do the underwriting as quickly as possible and as efficiently as possible. So with microinsurance, the biggest issue is keeping costs down such that it is attractive to the insurance companies. And I think that the solution there is the use of technology to, as much as possible, reduce the cost. That is why the use of mobile platform to be able to distribute it has caught on well, because that really reduces the cost of distribution there.
Yes, here.
Okay, so I'm going to just speak from a bit of experience from Bank Negara Malaysia, which is where I was from. My colleagues are in the audience, so hopefully I don't say anything that's inappropriate. But anyway, so how Bank Negara dealt with it, with microinsurance products, was that so there's a specific definition of what's considered microinsurance in the market, and so Bank Negara attaches a few key characteristics to this definition, and one of that is that at least 50%, at least half of the premiums has to be basically the insurance portion, so it has to go to the financial protection portion. As to whether this measure is effective or advisable, I think Bank Negara is kind of at the stage of experimenting with that, but basically just based on kind of IAIS discussions, where the discussion is at is that there isn't really kind of a magic number in terms of what kind of value or what kind of claims ratio insurance, microinsurance products or inclusive insurance products should have. And and as much as Stefan's kind of idea of shortening the value chain is maybe ideal, but fact is the direction of where the market is going is that it is increasingly fragmented. There are increasing number of service providers in the value chain, and as far as A2I is concerned, we haven't seen any answers as to how much kind of this layering of costs is adding to the cost of provision of insurance at the moment.
Final question. Okay. Well, thank you very, very much. I think, let me just summarize. For me, it's clear that the outcome of this discussion shows that Insurtech is actually delivering on its promise of making insurance markets more inclusive. I mean, there are concrete examples here. We can clearly see that the regulation and supervision continues to evolve. You were mentioning, Moses, about being open-minded. We've been discussing about, Seth was making the point about collaboration with the industry, working together. I mean, there are many ways in which regulation and supervision has adapted to the way, but clearly there is more work to be done. I mean, the issue of education was mentioned by Stefan. For instance, Jordan was mentioning the issue of multiple regulators. So there are things, a lot to be done, but I think we are in the right path, and I wanted to thank you very much for your time, for your contributions today. Especially thanks to Natalia Escobar, who has been the coordinator behind this panel, has done a terrific job. Thank you for your attention, and please, let's finish this with a warm round of applause for our panelists.